Welcome, everybody, to the Investors Podcast 2.0 Wealth Mindset, where we dive into the minds of the successful real estate entrepreneur to uncover the tips and tricks that have allowed them to keep moving forward. I am your host, Scott Bauer, and I'm excited that you're here with us. Hey, welcome back, everybody. This is another episode of the Investors Podcast, and I am excited today. I'm your host, Scott Bauer. Of course, you know that. You're a loyal listener. You've been here each and every week for a long time. And we got Nick Legamaro with us today. He's the USA Note Pro. He is the Note Pro that I know. That kind of rhymes, kind of funny. And you know what? We're here to talk about some cool stuff today. You're going to recognize Nick from episode number 99. Last time he appeared here on the show. And, of course, we were talking about notes back then as well. But, you know, we're going to kind of deep dive.
A lot has changed in a few months there, Scott. A lot has changed.
Amen to that. Amen to that. And I guess, why don't you touch on that for a minute? You know, let's talk about some of the changes that you've seen, and we'll kind of get everybody excited about this call we're going to talk about.
Yeah, you know, well, I think it's really been a weird thing. I think when I was on the call last time, I talked about, you know, I don't remember what we said specifically, but this was I think we did this last March, and we hadn't even really gotten to know what we're doing today with the whole COVID and pandemic and just the whole state of the market. But I had a really eerie feeling it was going to resemble somewhat what we went through in 07 and 08, especially with the number of foreclosures and that were going to be hitting the marketplace. And they haven't hit yet. They will be hitting. I think the number I saw recently was the amount of loans in forbearance, which means basically forbearance means that they just have pushed the payment back in time. Doesn't mean you're not responsible for the payment. This is if you own a property. This isn't relative to rent. We'll talk about that here in a second. But relative to being a homeowner, whether you have a mortgage with Chase, Wells Fargo, Citibank, you can go what's called a forbearance. And forbearance just means that you can't make the payment today for whatever reason, but you're still responsible for the payment, and you're going to have to make it at some point in the future. And depending on what type of forbearance you're given, makes a determination on when that money actually becomes due. Fast forward, it's been pushed back a few times. It was pushed back 2 or 3 times. And I think the last pushback, I think, is into the January 2021, waiting for the new administration to come in and figure out what they're going to do. But I will tell you this, it doesn't matter because banks always get paid.
Yeah.
Banks always get paid. Banks are the ones that control this, not the government. And at the end of the day, it's not a matter if the bank is going to get paid, it's just when. And that's the beauty of being the bank, which is why we're on this call and why we're going to talk about today on how you can be the bank, what being the bank means, and how everybody should really have the banking mentality and mindset, because there's a reason why banks are in the banking business. I know I've talked about this before, and I'll say it again. Banks are in the business of control, not owning. And that is a fundamental difference from what most people are taught and what they understand. They think they have to own real estate to make money and cash flow. Just not the case. That's why all the bank buildings in most cities are the biggest buildings in town. And I know we mentioned this before, and it doesn't say Cold War Banker on the side. They're not real estate companies with their name on the side of the building in the major cities and all the high rises. So once you understand the concept of control versus owning and still be able to cash flow and be able to still have control and leverage with that asset, it's a beautiful thing. And hopefully we can get into that a little bit here on this call.
Absolutely. You know, and we certainly will. Matter of fact, for the listeners out there, if you're watching this on YouTube, I think we're going to pull up a PowerPoint slide with some visuals for you to kind of follow us as we start to talk about this subject. And of course, if you're a loyal listener, which I know you are, then you've heard about notes. We've talked about it. I've had other guests on the show. We've talked about notes and what that is and why it's important and why I personally like this as an investment strategy. It's actually at the top of my list at the current moment. I think that there is so much opportunity to be the bank and to create notes and create paper around the real estate industry that is just a much safer bet where we're at today. And I think that's a good place to start because, you know, I just had a conversation earlier this morning. I was in a meeting with a guy and we were kind of talking about the difference between rentals. I've been acquiring rentals for the last few years. And I told him I'm not doing that anymore. I'm now turning all my rentals into paper. I'm creating notes for those tenants to make them owners. And, I'm creating notes outside of even rentals that I have. I just like the note business. And the reason why is because everybody listening to this call, most likely, is in the real estate business. And so you know that we've been appreciating in the marketplace for quite some time. And we also know that real estate is a cyclical business. And so at some point, I don't know when that is. I don't know if Nick knows when that is, but
I do not know what it is, but I do know a lot of things, and hopefully we can operate at a 95% confidence interval, which is a number that I like better than the unknown.
Well, but at some point it's going to turn again, and things are going to fall out. There will be a shift somewhere, and values will go down. Well, if I have rental property that, let's just use this as an example, that is today worth $300,000, okay? And tomorrow the market falls out, and now all of a sudden that property is only worth $200,000 if I go to sell it. Well, that's another important factor, is to the go to sell it part, because my property is not worth anything until I go to sell it, right? Because somebody has to pay me what we believe it to be.
Right, and you don't lose anything if you don't sell either, right? You don't physically lose. And I think that's another point that I think a lot of people get tied up. It's only a loss if you sell it for a loss. Correct. Otherwise, it's just a paper number. And I think that's why when we start talking about the notes and from the leverage that you have by being the bank, it makes no difference if the property goes up or down in value. The money that's owed to you is the same. The payment doesn't change. It always, now the buyer might care, or whoever bought the property might care if it goes up or goes down. But I'm going to show you later on, we're going to pull up a case study that I just went back and revisited after about 6 years. And I want to show you exactly why we do what we do and why we've done it, 500 plus times and counting. I mean, I don't even know the number. I stopped counting at 500 because it was irrelevant at that time. So anyway,
well, yeah. But I mean, where I was going with that is just that when you're creating the note, on the other hand, you're not susceptible to what's going on in the marketplace as far as the value, right? You create a note. And a note, for the listeners out there that don't know what that means, that would be, here in Arizona, a note and a deed of trust. It's just basically a promise to pay. It's like getting a mortgage for a house. Instead of you paying Wells Fargo, you would pay me, or you pay Nick, or you pay whoever the investor is that has created that paper. So anyways, where should we start, Nick? Where do you think we should start in the discussion here?
Yeah. So, I think the first thing I wanted to, make sure that for the people that are on this call, that they understand that, we're going to talk a little bit of how we're going to be the bank, right? How you can become a bank, how you can invest in high yield secured mortgage notes, either by buying them, creating them yourself, either from a fix and flip and then creating a mortgage note on top of that, or converting maybe like you were talking about earlier, a rental that you've been using for cash flow as a asset into making that a cash flowing mortgage note. We'll talk about that a little bit as well. So,
and for all the listeners that are out there that are listening to this, who this might be applicable to are the landlords out there that have, rental properties. It could be somebody who's doing fix and flips and looking for another exit strategy for it, right? This is somebody that has, that I already mentioned, existing rentals they can turn into notes. So, this is something I think is really applicable to a lot of people on this call.
Yeah, and I think a lot of people don't really, and it's not only that, we got to look at it even outside of the real estate landscape, because there's a lot of people that have been investing in the stock market, right? They invest in stocks, or with their own personal cash, or in retirement accounts. And I think a lot of people may not even realize that they can even use retirement accounts, depending on how they're structured, to buy and control real estate. So we'll dive into that a little bit later as we go along too. But really what I see in today, I want to just talk a little bit about today's environment, and from there we can go on. So today's environment, they're coming to the end of 2020. We've gone through this pandemic for almost a year now. We've had positives and negatives as a result of it. The market has been going bananas, and there's a lot of weird reasons why that is, and we can maybe have a little bit of discussion on why that might be and where it's going to go to. But at the end of the day, it really makes no difference. And it makes no difference to me, because I could care less who the president of the United States is. It doesn't matter what the unemployment rate is. Doesn't matter what interest is, because there's always a way to create. People always have to have a place to live, and if you have the ability to figure out how to provide that level of ownership and protect your investment, it's about as secure of an investment as you can make. So we'll talk about that in the coming part of the podcast here. But foreclosure and forbearance, I think I already talked. It's 5 million and plus and counting. That's all the government secured stuff like the FHA and the Freddie and stuff. Those are insured, but there's a lot of mortgages that have been written that are not federally insured. You know, seller financing. We'll talk about what that means and what it is. It could be conventional loans or even commercial kind of stuff. You know, and really, what is true unemployment? I want to talk a little bit about unemployment, because unemployment is definitely a deciding factor when it comes to becoming a homeowner and going out and getting a mortgage, and how that's what's just changed in just the last several months. For example, interest rates right now are historically low to go get a traditional mortgage, right? I mean, I've seen rates under 3% right now.
Right.
Well, that's great, but who actually, so there's a little false sense of, I don't want to say security is not the right word, but that's not for everybody. 2.99% is for well qualified. And here's the thing, Scott, is that as each year goes by, less and less people fit the pretty buyer's box. And the pretty buyer's box is what a traditional lender uses to very basically underwrite notes. It's stuff like a W-2 job. Well, you know it as well as I do, you as well as I don't have a W-2 job. I probably will never have a W-2 job. And for me, my ability to go down to a bank and get a traditional loan is extremely difficult without being a W-2 employee, and plus a lot of other reasons.
Right.
So what's happened here, and why being the bank and the whole prelude into seller financing is that we're talking about back in March of 2020, right before the pandemic really hit as we know it today. Banks, for 100 people if there was 100 traditional loan applications that were submitted that were approved, that same number has declined to 65 or 70%, but nothing's changed in the borrower's file. What that means is that their credit score hasn't changed, their DTI or their debt to income hasn't changed, they still have the same W-2 job, they still make the same amount of money, nothing has changed. So what's changed? Well, what's changed is that banks have gotten tighter on their requirements and to underwrite that borrower. So now, where 100 people could get qualified before for one specific type of mortgage, now it's gone down 30%, just like that. Just because somebody was able to make an adjustment on what their requirements are going to be. Mm-hmm. So that's sort of the kind of things that we're dealing with in today's environment. But let's look at it from an investor standpoint, which is why a lot of people are on this call, whether they're a real estate investor or anything else. We want predictable returns. We want cash flow. We would prefer it to be passive versus active, and we want high interest rates and returns with low risk and security. So, that would be utopia if we can get it. Well, very, very few investments allow for that, with the exception, in my opinion, are mortgages. So we'll talk about that.
Amen, man. And it's not really just an opinion; it's kind of a fact. I've actually, this is like a waking moment for me when I found out that this is a real thing, and it's legal, and it's happening all around you all the time, right? Even somebody that, let's say who is a real estate investor who's got into the rental game, that's what you kind of think is the right way to go, to accumulate a bunch of rentals as, you're building up your goose egg, so to speak. But then you find out that I have to pay property management, I got taxes, insurance, I got maintenance, I got, somebody didn't pay me, I got a victim, now I don't have any payments coming in for 90 to 120 days. Oh, they terrorized the property as well, and I got to fix it up. There's all these things that come with rentals. And then I found creating notes or now holding the mortgage, and now all of a sudden all of that goes bye-bye. I don't have to worry about it anymore. Tenants, toilets, trash, taxes, insurance. None of
No, absolutely. So the two things, the biggest argument I hear about being the generating revenue or wealth through cash flowing of notes versus holding a property and turning it into rental is depreciation.
Yeah.
Okay. Hear it all the time. And here's my simple answer to that. Who gives a rip?
that.
And because if it was that big of a deal and was that important, then Bank of America, Wells Fargo, everybody that's being a lender and controlling the deal would have a problem with it. And they don't, because you know what trumps that? It's called amortization. And when you run an amortization on a note and you get all your money up front in the form of the interest, and your cost basis and your risk goes down every month the payment's made, you can take your depreciation. I could care less. And that's the way that's my personal opinion. Now, if I was 20 years old or something, I might have a different perspective on it. But there again, I always go back to what do the banks do? Why do the banks do it? And that's the position I'm taking as far as that goes. And that's why I don't have any rental properties. And that's exactly why banks don't own property. They don't need to. They don't own rental properties.
Yeah.
Otherwise, they'd have multifamily buildings or commercial buildings. They just don't. They don't want it. They want to have the cash and the leverage of the property. So.
Well, Nick, let's do this. Let's share this. I want to share the PowerPoint that we have here for all the listeners out here to kind of look at. I know that it's not the presentation side. Let me see if I can do that. Okay. Can you see this, Nick?
Yeah, I can. I can see it. Fine. Perfect.
Good deal.
So, we'd already talked about, the whole concept of what this is I learned a long time ago, and I don't know if we talked about this last time, but I've been in real estate since early 2000s, like 2001. And I did everything that, first of all, there was no education back then. There was no HGTV this, there was no REI clubs, there was no educators, there was no masterminds, there was Carlton Sheets, and that's probably about it. And Ron LeGrand. So from the real estate, props out to both of those guys because they helped set the thing. So what I learned a long time ago is how not to do deals. So my experience on failure hopefully can translate on this call and in the future to people that are, really sort of struggling with that idea on why they might want to try something or not. And this was, I like bringing up old data that's still relevant today, because I think in today's landscape, it's really easy for people to get carried away in the moment now. And you have to be prepared for change. And I think that's what we're seeing right now. But conceptually, some things just don't change. And this was an article in the Washington Post. I'm not going to read the whole thing. It says buying mortgage notes can provide a savvy investor with secured returns without the hassle or risk of buying and flipping fixer-uppers. This is exactly what we've been talking about. This is from the wall, and it goes on and talks about, why, banks are in the private mortgage business. No different. So let's go on to the next slide here, because I really want to set the tone so we can set this up. And so that leads us to, you have two types of financing that's available to go either buy a house. You have the traditional market, which we've been talking about, which what the big banks do. And there's the seller carryback note, which is the creative financing or the seller financing aspect of it. And, the question I always ask is, how big is the seller carry note market? Because I don't think people really have an idea what that is. And usually most people guess way, way low. And we'll just go to the next slide, and it tells you it's about $26 billion, Scott. I mean, that's billion with the B. So that is all the seller notes that are created by either individuals or small companies like USA No Pro or American Capital, which are the companies that I manage and run, that make up that $26 billion. And that's a lot of seller financing. That could be on single family, it could be on land, it can be on commercial properties. So go on to the next slide real quick.
So I want to stop here though. I mean, this is 2019 dollar volume. Now this is 2020. Do you think this will increase or decrease based on what we've just talked about?
I don't know. So I don't know what 2020 is going to be, but the next slide, I think, will sort of show the trend. this number is going, yeah, okay, so this is through 2018, but you can look at the first line here, which is really well, you can look at the bottom line. It went from 20.7 billion to 20.8 billion to 22.2 billion to 25.9 billion. So it's gradually gone up in time. And this is on data, and you can see where it's reported. This is from Advanced Seller Data Services. This is where the data comes from, Scott Arpan. But this is all first position notes, loan balance greater than $30,000, 2,137 counties reporting on a national basis. So the average loan that's being written right now is north of 150. So this isn't like 10 years ago when we first started, where the only way you could buy a property was with seller financing. Because whether you're a borrower, some properties you just can't go get traditional mortgages on. Right. For example, if it's under a certain dollar value, maybe the threshold at a bank, Plains Capital is $60,000. The loan amount has to be a certain dollar value. Well, what if the house is only worth $50,000? There's a lot of places in this country where you can go into Indianapolis or, parts of Missouri or the middle Ohio, the middle United States, where you can go get a really, really nice 3-bedroom, 1-bath house, with the garage for 60 grand. They're all over the place. Right. People sometimes think that because they live in a hot market. You're in Phoenix, I'm in Texas, Dallas, Austin, the California, New York, the dollar values are high. So those properties must be not very well. And we're going to show an example here as we get to future slides. So this just shows you the note volume. And I think it's important to realize just how big of a market it is and how we can materially participate in that and how it's a commonplace as we go on. Because as we go on each year that goes on and less people can qualify traditionally, there's such a huge demand for seller financing. And it isn't that they're not good borrowers. They just don't check all the boxes for a traditional lender. Either they don't have, they're not a W-2, or, they're self-employed, or they haven't been in the job long enough, or in where we see a lot of this in Texas, we have a lot of buyers that are international. They can be Latino, they can be from Central America, they can be Canadian, it can be anywhere, Indian, Chinese. And what happens is that they are issued what's called an ITIN number, an individual tax ID number, which basically says that they have the right to work in the United States, they have the right to pay taxes in the United States, but they can't go down to Wells Fargo and get a loan. Yep. But they can do everything else. So the ITIN number is something that we use and some other small cap lenders use, or individuals, to go create what the paper that you're seeing today. Yep. We still underwrite the file the same way. We still use an RMLO, which is a residential mortgage loan originator, and we still stack the file the same way as Wells Fargo or Citi or any of these guys. The difference is one of those key components of the traditional buying box hasn't been able to be met, so therefore they're automatically rejected.
Our guidelines are just a little bit more, I guess they work better for more people out there, right? It's not such a strict box that you have to qualify.
They're dealing with old rules and regulations, or whatever you want to call it. Yep. And times have changed. Yep. And they have not adapted to the change. And until they do, which I don't think they will because they don't have to, we'll continue to do what we do, and we'll do what we continue to do at the same time.
Amen. So, well, let's keep moving here. So yeah. Let's see. This has happened. Let's see. What is this next slide? What are we looking at here?
Yeah. So this is here's why I brought this slide in, because if it starts in 2009, and this is basically seller finance usage. So you can go back to 2009, and from 2009 to 2014, you see a pretty aggressive increase in the number of seller financing deals. And why I think this is important, because what happened before 2009? What happened in the years from 2007 up to 2009?
We had the market fall out, right? We had our Great Recession.
Market fall out. Lenders stopped writing notes. There's all the stuff that came back, all the bad notes that were written. And so they did a reset. Well, guess what happens? People still need to have a place to live. Yep. Hardworking families still want to have home ownership. and they weren't able to get so through traditional banks because they had their own problems they were dealing with. They were writing notes, but not nearly at the capacity they were writing or the amount they were writing before. So here we go. We're getting close to that point right now because people have been out of work. They've been changing jobs. Eventually, there's going to be that same kind of correction in this number. If we look at this 4 years from now, I think you'll see from 2019 to 2022 a fairly similar increase in the number of deals. So, and they didn't drop very much actually after they went up. They didn't drop very much from the peak in 2014, but everybody could qualify back then for the most part. So, all right, enough with this slide.
Keep going on the next one. Okay.
So here's where this is where I want to spend a little bit of time on. So Rilix Capital was one of the companies I started back in 2010, 2011. And we created many notes by buying a property, fixing the property, finding the buyer, creating seller financing or providing, being the lender on the property that we own and writing the note. And then from there, we would likely sell the note to be able to do that. So,
and you, by selling your note or a partial of your note, you be able to recapitalize the money that you spent on
yes.
on making that note. And there's actually a strategy where you can really profit on that very largely, which we'll go into maybe later, at another time. It's a little more advanced.
So here's a note I wrote back, and this is an actual note. It's still in servicing. And you can go you can look all this stuff online, but I want to show you things. We wrote this note back in 2014 of July. The promissory note was $76,500 at an interest rate of 10%. Okay. So let's go to the next. So this is the note that we wrote against the property. We sold this property for $85,000, got the down payment, and then the rest was finance. So fast forward to today, I literally just pulled this up off the internet this week, and now the house is worth $170,000. Okay, now what does that mean to me as a lender? It doesn't mean I have anything worth. I don't get any of that value besides the note balance that I have, but I'll show you what it does do for us when we go to the next slide. So now in less than 6 years, this house has literally doubled in value, right? So what does that mean from a lender? Is everything going to double in value? Absolutely not. But here is the amortization schedule that was created back in July 2014. And you can see the original balance was $76,500, rate at 10%. And the principal and interest payment is $671. Now, we don't care about taxes and insurance from a modeling standpoint because we don't profit from taxes and insurance, right? Those go to the insurance company or the county or wherever. But we do care about the principal payment and the interest. So if you look at here on the first payment that was due, the original balance, $76.44, the first payment that was made is $671, but $637 of it was going to interest and only $34 went to principal. And as you scroll down on the amortization table, that eventually starts to flip, right? It starts to change. And at about year 23, depending on what the interest rate is on a 30-year term, you'll get to a point where the interest and the principal is about 50-50. So if this payment was $671, in 23 years, you'd be paying about $320, $330, $340 principal and interest. So what does this mean? So now we know today the property's worth $175. All right, we already know that we have the first lien, and it was already secured by the property 6 years ago when it was worth $90,000.
Right.
So let's go to the next screen right here. So, oh, by the way, if you multiply 671 times, we're in December 2020, 78 payments times 671 is probably about $50,000. Okay, so we loaned $76,000.
Yep.
6 years ago. We've collected $50,000 against our exposure. So our cost basis in theory is dropped from 76 down to 26. But what is our asset? What is our protection on the deal? Well, we know it's $170,000, but let's just say that we get a phone call tomorrow and the seller has decided, excuse me, the buyer has decided to sell the house, and we get a call from the title company. Well, we're the bank, right? The title companies call the bank for payoff. They're calling us for the bank. What's our payoff just 6 years in? Well, it's about what is that, about $72,800. We're getting another check back for $72,800 if and when that was to pay off. So, but really people are mostly concerned about what happens in the event of a default, right? What happens if the buyer doesn't pay any longer, which is what we're seeing a lot right now with traditional mortgage. Well, you can do a loan modification, you can do a deed in lieu, so deed in lieu of foreclosure, you can do cash for keys. But at the end of the day, you think for 2 seconds I'm concerned about this guy defaulting on this note?
No, not why would it be a dumb bet for him?
Absolutely. Now, I don't get to keep, if I foreclose, this changed, right, from before. If I, at the lender, as the bank, foreclose on this, I don't get to keep the difference between what he owes and what the property sells for, say, at auction, right? But in this situation, he would never let this probably happen anyway. And even if he did go to foreclosure, only thing I would get back is my principal balance, okay, which is $73,000, plus whatever my legal fees and foreclosure fees and stuff like that. But I've just made all my money on the front side because I'm getting, my principal balance only went down $3,000, give or take, but I made $50,000 in cash flow because of the return. So that's why we do what we do.
So in that example, right? So you collected $50,000, and let's say that they defaulted or whatever, and you had to, or let's say they sold it. Now you're going to pay off. They're going to pay off, and they're going to pay you when they sell it $72,800, right? So you not only now you took your $72,800 plus the $50,000 you've already put together. That's $120,000. You know, give or take $125,000 that you would have gained off of that asset, which is great. Now, if they would have defaulted and, you know, stopped paying you and you had to foreclose on them, then what could you have done? Then what would have been, you know, if you wanted to keep that asset and turn around and resell it again? Now, you know, explain that to people, because this is pretty exciting.
So you're saying if I was to go to the bank and take it back, you mean? Like I bought it, or say I didn't go to foreclosure and I got a deed in lieu of foreclosure. So I gave them some of their equity position back, right?
Right.
Or whatever the case may be. Well, guess what I would do? I'd go do the same darn thing I did the first time, right?
But now the property is worth $170,000. So now you can go, you know, ask for another 10% down and create a new note based on that 10% down. And you know, and so.
Yeah. I would never keep all their equity. But isn't that the same thing that you're doing when you go buy a wholesale deal?
Yeah.
When you go buy a property wholesale, isn't that exactly the same thing? Aren't you buying it at a discount, going to add value to it and resell it?
Yep.
Right? Otherwise, you wouldn't be able to make any money. And the seller knows that's exactly what you're doing. Well, the seller in this situation knows the same thing. They might not have the capacity. They may have had to move. They may have had a death in the family, whatever, and they just need to liquidate the property, and they want to get it as close to fair value as they can. And they have to understand there's going to have to be somebody's going to have to make a profit on the deal. Well, I'm not going to take in this situation if I'm owed $75,000 and the value is $170. I'm going to go in and I'm going to treat it just like I would a traditional wholesale deal. And if you're a wholesale buyer, which you are, and that house was worth $170. And what's your offer going to be to that seller? What's the offer going to be?
Well, I'd probably jump, I don't know, 30% discount off of that. So 170 based on, you know, whatever.
Probably going to be 140, 135, give it 130.
120, 125.
120. So now 120. So then if it's 120, so now I'm taking that property back at 120, and they're going to get the difference between 120 and what they owe. So they're going to put $50,000 in their pocket to go out and do what they're going to do.
Yep.
I'm going to have all my capital back, and guess what I have now? I got another house I can still go do the same thing with I just did 4 or 5 years ago. And that's what we do. And that's, but here's the thing, Scott, we very, very rarely get any of these things back because people just don't default, because we really try to underwrite the borrower as best we can. We want to make sure they have an equity position in the property.
Yep.
So that if they get into a bad position, they can do it. Now, what I could do very easily with somebody with this much equity, let's just say that they had a hiccup and they couldn't afford to pay for whatever reason, they lost their job or whatever. what we call debt equity in this deal, right? They have all this equity tied up in this property, and they can't do anything about it. They can't get it out. They can't, they've got, in theory, almost $100,000 of equity in this example, and there's not a darn thing they can do about it. They can't, chances are this borrower probably can't go down and necessarily go get a home equity loan if it was even available in the city that state that they're in. So they're really sort of handcuffed, but we can come in and do a loan modification, right? We can come in and do a loan modification, and we can move some stuff around. Our principal balance is always going to be protected because I have the asset as collateral. You don't have that when you go buy Amazon or Tesla stock, do you? You go buy stock and it goes down 20%. You're not going to Elon Musk or Jeff Bezos and go, hey, my stock's down 20%, but I got to sell because I need the cash. Can you help me out? It's just not going to happen. So anyway, I just wanted to show how the asset is protected and how it's truly passive. Because let me ask a question. How often do you call the bank for the mortgage you have on your home?
Yeah, basically never.
Never. Never.
Yeah,
and guess what? These borrowers don't call the bank, which is me or us in this situation either. They don't have any reason. They don't have any reason to call us because they're not calling us for a leaky roof or,
the light bulb burnt out. The toilet doesn't work.
The toilet doesn't work. That's not what they do. So they call if they have an issue with the payment, and that's very, very small. Our default rate on this stuff that we either buy, create, or fix is extremely low because we had to go through a very specific due diligence process.
Yep.
And at the end of the day, can't predict the future, but you can sure mitigate your risk by doing certain things that are really important to protecting your investment. The biggest challenge and the biggest risk that a note buyer has is probably fraud. And fraud in the sense of that some of the documents were there was some fraud either in the recording of the deed of trust, some of the liens or that weren't cleared but said that they were. Those are some of the risks, but that's why you have title insurance and some other things to help protect that position. So anyway, I hope that helps understand that. So here we are on the due diligence side. So, like I said, you can either buy a note, and what does buying a note mean? Well, buying a note would mean buying a note that from one of those $26 billion notes that has been worth the notes that have been written from an individual or a company like us. And those notes have to be, if they're created, we obviously know all the details of the deal because we did it from the very beginning. However, we do a lot of transactions and notes. We buy and fix notes and sell notes all the time. And they may be, and I was just looking at one just yesterday. It's been performing for 5 years. Well, but I don't know the history of that. I don't know what it looked like 5 years ago. I don't know what the borrower. I don't know any of the history of that. So you have to go, and you have to do due diligence. And due diligence basically is going through and making sure that the file it passes the smell test, for lack of a better analogy. Right. So we use title companies to pull title commitment, make sure there's no additional encumbrances on the property, like there's somebody took out a home equity loan or things along those lines. We like to have had hopefully there's an RMLO that was done initially. A lot of times they're not. So we have to go back and sort of create that file to make it look right so that we can really understand that the paperwork is intact. We use attorneys and trustees. We never close any documents outside of a title company. Even when we do the notes, we still use the attorneys for that. We always use mortgage servicers. And a lot of times, and I think we didn't talk about it, but of the $26 billion of seller financing notes that are written annually, well north of 90% are done what we call mom and pop. And mom and pop is somebody that just does probably one of these notes in their lifetime, maybe two, but they're not a professional company like a USA No Pro that goes in and actually creates the paper. So why is that important? Well, it's important because most of the time, unless you do 3 is the number, 5, depending on how you look at it, you don't have to go through traditional underwriting requirements. You can write the contract on a paper bag and take payments in cash and never consider any of the qualifications of the borrower. we always use an RMLO servicer, an RLMO, and a servicer as third parties to help verify and make sure that the payments are processed correctly. The borrower is who they say they are, and we keep things in accordance to Dodd-Frank, et cetera. But if you're only doing one of these, none of that stuff applies according to the rules. So, however, if we're going to buy a note and you wrote this note and you didn't have a servicer or you didn't have an RMO do the thing, we need to bring that in, and then we need to reset the file and make sure that everything's in order, because before we turn around and want to sell that note or stay in that note long term, we want to make sure that the paper is as good as we think that it is or should be. So, and that's what a servicer does. A servicer, if you've ever had a mortgage servicer, is just a third-party entity that manages that payment on behalf of the lender, right? So we always use a third-party servicer. And why? What that does is that the borrower makes the payment to the servicer, not to the bank or the lender in this case, which is us. They'll make it to Allied or there's NAMS. There's a bunch of servicing companies out there. And what they do is they take the payment and they take the full payment, which includes the taxes and insurance. They escrow taxes and insurance, and they basically pay the P&I to wherever it needs to go according to the promissory note. So that's an important piece of it too, because then if you ever going to go sell this note, you have a third-party verification system that says, yes, this borrower is paying, they pay on time, and we're responsible for collecting. And instead of you buying a note from me and I say, oh yeah, he's been paying me cash on the 3rd of every month and he's never missed a payment, right? A little hard to validate and prove. So that's why you want to do this, because notes are like cars, and a vehicle, you could have two identical Ford F-150 trucks, right? Same make, model, year, mileage, everything. The difference is one is beat the crap with the scratches and dents, and the upholstery's got stuff all over the inside of it. And that has a lot less value because of the condition. No maintenance was ever done on it. Tires are bald. That has a lot less value in the marketplace than if something that was in pristine condition and it had been kept up and serviced correctly. Same thing with mortgage notes. That's why whenever somebody goes, well, how much are you going to pay for a note, or what should I pay? It just really depends. And these are all the factors that come into play. We want to know, we want to have contractors available if we need to go do an assessment or a drive-by appraisal or a BPO or whatever. And all these other, we use realtors in markets that we don't have physical representation in to help us assess the value and make sure that the property meets the qualifications that we set forth. Yep.
This is all good. And so for all you guys listening that are in the car, maybe jump on YouTube, because we have the copy of the slideshow here that you can reflect back on. But let's go to the next slide. So next thing is kind of go over some FAQs. I know you put together a few from the very beginning or before you put together this PowerPoint for everybody. We can talk about these, and I probably will be able to come up with a few others as well. Maybe a couple of popular questions could be, if I have a note, and I buy a note or I create a note, how is that secured? How is my money secured to that property? What does that mean?
Yeah, so basically we talked about this in the very beginning, how a bank controls versus owns. Well, this is the same thing. So when money is lent on a property on paper, then the property becomes the collateral for the debt, right? So and a house isn't going to get up and walk away. So it's not like it's a guarantee that it's not an unsecured debt like some people would maybe like a credit card or something like that. The property actually secures the debt on the property, and that's how it's protected. So obviously it's really important to have, whether you're buying or creating, that you want to create either you want to look at what the LTV is, which is the loan to value that the borrower has on the property. And I would say I would never want to see a loan to value greater than 90%. Yeah. So that means that they would have to put about a 10% down. I know a lot of people require less money down, but it's really, really important for this to work, to make sure that you put the borrower in a position to succeed, not necessarily the investor, because you want to make sure that in the event of something coming up, that they have some equity position in the property.
Some skin in the game.
Yeah. Then there's the investment, the value, which is if you're going to buy a note, for example, say you want to go buy a note in your retirement account, okay, and the value is $100,000, and the UPB is $80,000, and maybe you get a small discount and you buy it at $77,000. Well, now your investment, the value would be 77%. And that's a good value because there, again, it goes back, that's really the only number you probably truly care about, because in the event of a default, you're owed 77, the property's worth 100. You have space in there to be able to recover your initial capital investment.
And so that would be the same investment. Another way to put that is loan to cost, right?
Yes.
Loan to cost. Next thing we have on here is talking about high interest rates. You know, in the case example we talked about before, you're charging 10%. I charge 9.9% here in town in Phoenix. Why would somebody, when rates, you know, you look all over the place, rates are 3%, less than 3%, less than 4%, whatever. They're low interest rates today. Why would somebody pay 10%?
It's a great question. And you know what? It's funny, Scott, because when I first started writing notes, I would say that probably 3 or 4 out of the first 10 deals I did, I got asked that question. Why is my interest rate so high? And I really didn't have a good answer at the time. Well, the reason why it's so high is that, one, you know, if you don't like first of all, when you write, we're allowed by law to write to what's called APOR plus 6.5% to keep it a qualified mortgage and keep everything in line with what the rule, with about it being a high cost mortgage. So APR is an annual prime offer rate, which is a government index that comes out on a regular basis. And if you're using an RMLO, that's the number they should probably be using to make sure that you keep it in that thing. So right now, I think the APR is probably somewhere down in the low 3s or high 2s maybe. So there's some other things you can do with the term that get you a little half-point bump and some other things. But that's why we always defer to the RMLO, and we say just write it at max of APOR, at max plus APOR, and you'll never have a problem with that being, you know, being considered predatory, being a predatory lender or something like that. But why do buyers pay the interest rate? And my question always is, well, what's the interest rate on rent, right? Let's assume that you can buy this property for $1,000 a month, or you can rent it for $1,000 a month. Okay, what's the cost? What's the interest rate on rent? And the answer is, it's infinite. You can't calculate it because of the fact that you don't get any value on rent back. Every dollar you pay to the landlord gets kept by the landlord. You get no financial benefit from renting whatsoever. Yep. At least when you own and you pay a 10% interest rate, guess what you get? You get to deduct it on your tax returns. You get to deduct the interest expense. You get to deduct all the other cost of ownership that you have relative to that house. Plus, guess what you're doing? In that example that I showed earlier, they bought that house for $80,000, right? $85,000. They're paying 10% interest on it. They still owe $75,000 on that house, or $73,000, whatever the number was, 6 years later. But what do they have? They have equity now in the house, right? So when they go to sell that house, all that money that they paid towards interest that they've been deducting on has paid dividends on them, because now they have a house that's gone up in value. Now, do all houses go up in value? Absolutely not. Will all sellers make money when they sell? Absolutely not. But in that situation, in most situations, that's what actually does happen. So that's why they pay the interest. Plus, they want to have home ownership versus renting. It's just that simple.
Well, and the other thing too is they can't go to a big box bank and go get a loan at 3% because they don't qualify for that for whatever reason, right? They're kind of pinned into a corner in a way, and this is not predatory lending. That's not what we're doing, but we're just saying, you know, we're taking on the risk of you not qualifying in the box that the big banks require you to be in. Therefore, we're going to charge you a little bit more interest, but it's really just, you know, at the end of the day, the dollar that they're paying every month is really what makes sense. And like my rule of thumb here in town is that the P&I, or principal and interest payment, that I make my borrowers pay, or that we require, is it's going to be just below what the rent value is. So, you know, they can only, if they go to rent something, they're going to be paying more money than what my mortgage is. So who cares what my interest rate is, right?
Yeah, I mean that's pretty much it in and of itself. And look, here's the deal. There's no prepayment penalty on any of the notes that we write, period. They can go refinance tomorrow. That's up to them. They can pay it off without penalty. That's completely up to them. There's no, and if they don't think the offer that we're in, look, we're not overcharging for the property. It's not like we're taking a $100,000 house and charging them $150,000 like some people do. We sell it at fair market value, but at the end of the day, they can surely not take the deal. There's no pressure to do it. They can go find another house to rent. That's the beauty of what we do. And they have options, and we're just providing them the ability to have home ownership in the event of being a tenant if they choose to. And it's not for everybody. And they have to understand the benefits and the costs associated with doing whatever they choose to do.
Absolutely. The next couple questions, I mean, how do I collect my monthly mortgage? We've kind of talked about the third-party servicing company that actually adds credibility to your note that you create or that you have. That's how we would collect our mortgage payment. The servicing company collects the payment and then they give it to us, right? Next question is about servicing the loan yourself or using another mortgage servicer. We've kind of talked on that as well because, I mean, it's you want to have that third party service to verify and validate what you're saying, and it goes above and beyond what your word is, right?
Yeah. Oh, here's a good point. And I didn't really talk about it earlier on, but we're writing notes most of the time somewhere between 20 and 30 years on term. Okay.
Yep.
Well, in that time period, if you are a note holder, you have to understand that these notes are extremely tradable, right? They're very liquid, right? You can't don't go down and cash it in today and get paid tomorrow. But the ability to sell a note for cash and have a value assessed to it, you can easily do that within 7 to 10 days. It's fairly liquid. So let's just say that you write a 30-year note today, right? And this is why we buy notes from that 92% of those $26 billion in seller financing papers there. And it's really, really simple, is that individuals have life events, right? Yep. And if you go write a note today, life gets in the way. You have marriages, you have weddings, you have college graduations, you have cars that you need to buy, you have health. And the likelihood that you can afford to have a $500 a month, well, let's go to that example with $670 a month cash flow. That's a great deal if you can afford as an individual to ride that out for the 30-year term that it's been written for. Right. But let's say that, 5 years goes by, 6 years go by, we're here today, they made $50,000 on it, but guess what? Now they need a lump sum of cash for one of those life events. That's the beauty of it. So you need to make sure that the paper that it's written correctly and stacked correctly, because you have to write it as if you're going to sell it. And if you're going to sell it, you want to make sure you get maximum value for it. And those are the reasons why you do all the things that we talked about in the due diligence, so that the file was pristine. Because even though banks can't write the paper that we write because of the borrowers don't check all the boxes, what they can do is buy this paper, and we sell it to banks and financial institutions all the time.
Yep. Amen. Yeah. And there's a whole strategy for that, which we could talk about on a whole nother podcast at another time. But they're very sellable assets, right? Absolutely. Now, if the homeowner defaults on their payments, we've already kind of talked about, you can foreclose. And so what does that really mean? How extensive is that foreclosure process? And is it state specific?
So you have judicial and non-judicial states, right? And judicial state means you go in front of a judge, and non-judicial means you go to the courthouse steps, depending on what those foreclosure procedures are. So I stopped counting at 500 mortgages. There's well north of that. But I could tell you this: I know how many that went actually into default status, and the number it was last time I checked was about 15 or 16, depending on how you look at one of the deals. But here's what happened on all of those. The breakdown was we got deed in lieu on the majority of them, or cash for keys. Only 3 of them actually went to foreclosure. Okay. And the reason why they didn't go to foreclosure is because we tried to, there was one short sale in there and 1 loan modification. But there again, all that is something that we have control over, and we don't have to give up anything that we don't want to give up. So foreclosure is only a problem if you don't know how to react to a default. That's why third-party servicing companies are very, very important in this process, because guess what they do? They're the first line of defense when it comes to getting a payment or working with the borrower to make sure you get paid. Because I mean, I can't tell you how many notes that I've looked at to buy, Scott, that people go, oh, they stopped paying. Now they're not paying at all. And, you know, they're not in a position, the note holder or the bank in this situation, they're not trained or in a position to go after and collect that debt as a third-party servicing company would be. So the money doesn't get paid, and then it goes into default or a non-performing note. And then we have to come in and either buy it at a deep discount, or we got to come in and cure the note in whatever way that is. So I think most people are usually willing, are usually willing to work through it. But like I said before, if you write it correctly and you have the correct investment value or cost of value, whatever the term you want to use, it's not a matter of if you're going to get paid, it's just when. And that's how we want to make sure we position most of the notes that we write. And we never look at forced appreciation and it's going to create those spread, because we honestly don't care about any of that.
Well, and it's not fix and flipping, right? I mean, that's not the same type of thing we're talking about. I mean, I think, you know, at the end of the day, our presentation's done, so I'm gonna stop the share here. Okay, so at the end of the day, you know, creating notes and being in the note business is just a super profitable, safe, you know, fun place to be, because you're able to give home ownership to people that wouldn't otherwise be able to get home ownership. You're able to, you know, get rid of the headaches of owning rental properties. You're also able to, there are multiple ways that you can make money off of a note. And you could resell a partial of it. You could resell the whole thing to recapitalize the money you spend on the note to buy it. I mean, there's many different ways. And so what Nick said at the beginning of the call here is there's a reason why the banks, you know, have the largest buildings a lot of times in a city, but yet they don't own any real estate. They just control the paper. There's a reason for that, you know? And if you look and you study what the big banks have done, you look and see what some major investors in the world have done, they own the paper. The paper, when I say paper, it's the mortgage, or they own the security instrument that controls that piece of real estate. That's, you know, that's where you can make a lot of money. And so, you know, Nick, that was a good deep dive, I think, for everybody out there on the process of owning and buying notes, and, you know, kind of what to expect.
Yeah, and I think the last thing I want to say on that is that you can participate in this in a lot of different ways. If you, like I said, if you're a landlord, there's ways to convert that into being a note. Or if you're a fix and flipper, by adding the creative, by selling that property with creative financing, could yield you actually more money than trying to sell it retail, because there's the amount of buyers that need creative financing or seller financing to purchase is greater. So if you create the paper, and there's a lot, you know, we don't have time to go through it on the call, but that's what we used to do. So that's how I got into this to begin with. We figured out you could make more money by doing a fix and flip and adding the creative financing component to it, and just adding a little bit more to the process and get an extra 20% out of the deal. You have to do less deals by doing it that way. Or the third option is that you can use this as a vehicle to diversify your investment strategy, right? Where a lot of people have money tied up in the stock market or in CDs or bonds or whatever it is that they invest. Look, I don't own one stock. I haven't owned a stock in a long time. I don't plan on owning any stocks, and I don't plan on owning any real estate anytime soon. And the only reason I'm going to own real estate is because I take it back and I own it as an REO for a short period of time. But it's inevitable that it'll be gone. But if you have working capital and you want to diversify your investments, look at notes, because it's a great opportunity to cash flow in a very secure in a very secured environment. That's number one. Or if you have retirement money, you have the ability to depending on how you're set up with the administrator and what types of accounts you have, you can utilize those funds to buy notes. You can also use those funds to provide financing for different transactional kind of stuff. Yep. And you can always move your money around in IRAs. I would look, the IRA market right now, the amount of money that's available that's in IRA retirement accounts, about $35 trillion. $35 trillion with a T. That is a ginormous number. Cash holdings in most retirement accounts is about 5%. So we're talking, if those numbers hold true, and you could eventually do it, you're talking almost $2 trillion of money that's sitting in accounts idle right now because people don't know what to do with it. Well, you know what? Go buy a note. Even if it's a 20 or 30-year term, it doesn't matter because notes don't usually go to full term anyway. And you're going to get a nice paycheck on a monthly basis and a nice lump sum. And you know what? If you ever get into a situation where you need that money back, guess what you can do? You can sell the note, cash back out, and make a nice return in the meantime.
Well, and like, I want to give the listeners that are listening to the show, you know, some real life, you know, I guess, examples. So in my note buying business, I have an investor that loans me the money that is in first lien position. We pay them 6 to 8% every year on their money, which is a great return. You know, you might be invested in the stock market, which, you know, this year has been up, yes, but it's not always going to be like that. It definitely goes up and down with an average return of what, 6 to 8 or 10%, depending on what you're
not
in.
Secured, but it's not secured.
Not secured at all.
Not
The investments
at all.
that we provide are absolutely secure. You can go see them, feel them, touch them, and you're in first lien position, meaning that if there's ever a default, you're the first person to get paid. And so my investors that invest with me on this, like they love it because there really is there's not a lot of risk for them at all. They don't have to service it. They don't have to talk to a tenant. They don't have to make repairs. They don't have to do anything. They just really, they put their money into the asset, and the asset pays them every single month for years, you know. And so
you can do it short term or long term. You can keep your money in as little or as long as you want, and you know, it can be done anywhere in the United States. And that's why I love it, and that's why I will continue to do it until something else comes up. But banks have been doing this a long time, and I don't think they're changing their model anytime soon.
I don't really plan on changing out of that either. You know, it's such a good model, something that has changed the trajectory of where I feel like my business is going, and really my life, my family's life moving forward. So hopefully all you listeners out there that have stuck with us for this last hour and 15 minutes or whatever we've been on the call, hour and 20 minutes, you know, that means you know, this resonated with you, and it should, because this is real life stuff and everybody can do it. It's not limited to, you know, not limited. You don't have to have a ton of money in the bank. You don't have to have access to a lot of crazy deals or anything like that. Everybody has the opportunity to put this into practice, especially if you listen to the Investors Podcast.
I'll add one other thing, and it's probably one of the most important things we can talk about moving forward is, you know, you can go negotiate stuff with sellers if you're a buyer and buy them on terms as well, right? So you can go buy I'm not going to get into the subject too, but you can buy a property with seller financing in place, and then you can turn around and then sell that same property on terms to another buyer and make a difference on the spread. And that's a beautiful thing once you understand how amortization works. I just picked up a house literally last week up in Wisconsin. I got 0% interest and zero money down on the deal. And now it needs work, but I'll turn around and sell that, and I'll get a little bit of cash up front, and I'll probably do a seller carryback at, even if I carry it back at 5%, all it is free money and cash flow for as long as that note is in place, just because I have the ability to create the deal. Now, everybody that's listening is not going to have to do it, you know, and you'll have to either learn it or you'll have to partner with somebody like ourselves. But that's what we do. We help people to create deals, and we help people do deals, and we don't do it. We teach them. We don't really teach them how to do it yourself, because there's a lot of compliance and regulations that you have to be careful of. But we show you, you know, do it for you. And then maybe there's some way that we stay in on the back end of the deal. We stay in as a second lien holder, or we stay on as the management component, you know, at a small fee to keep that primary investment protected for as long as they're in the deal.
And you know what, for the listeners that just heard that and thought that was a lot of information, you have no idea what we're talking about. These are kind of advanced sides of things, which is okay. But, you know, actually, Nick, where can the listeners, if they want to reach out to you and learn more about what USA Note Pro does, if they want to, you know, see some of the investments they might be able to get into, if they want to learn more about how this works, how to do this, where can they find you?
Yes, so you can go on our website, usanotepro.com. You can reach me directly on there, or you can send me an email at nick@usanotepro.com. You can go on there. There's some download stuff there. We sometimes will post like some case studies and things like that. So we can sort of educate, because at the end of the day, what we do is not difficult. It's just complex. And with complexity, you have to be careful. So we don't really like to teach people how to do it, because we don't want anybody to make a wrong decision and have that financially impact them, if at all possible. So we want to really be able to help educate, and then if they choose to partner with us, there's ways that we can do that, and that's on a case-by-case basis, depending on who and where it is. But if it comes down to capital, we provide. I think we're looking at about 10 or 15 million dollars right now in assets that we have access to under management, that you can very easily say, hey, I want to go buy $100,000 in a note. What would you recommend, or how would you do it? And then we would go through that whole collateral underwriting process on behalf of the investor, and help them make sure they make the right decision for what they're trying to accomplish.
So in essence, I mean, Nick's a wealth of knowledge and information. If you just visit the website, which we'll put a link on into the show notes, kind of get started, ask any questions. And of course, for me, you know where to find me. Reach out to me anywhere on the podcast. You can always go to the HBSB Holdings website. Of course, you're here listening to us for this amount of time, so you know how to reach me. And I'm always happy to answer any questions I can for anybody out there. But, Nick, we're coming up on time. It's been a longer than normal podcast, but I know we dove into a lot of stuff, a lot of information for the listeners out there. And hopefully it was, really beneficial, and we had a ton of people stick with us. Of course, make sure to like it, share, and subscribe if you're not already subscribed to the podcast, so you don't ever miss any of them. And, reach out to me, reach out to Nick with questions. We want to see the interaction. I want to answer anything and give any help I can to those that are wanting to get into this strategy, because it's pretty freaking cool. I'll tell you that.
It's a great thing, man. Once you figure out how to use it to your advantage. And there it is, man. Hope that answers some questions. Hopefully we get some people that we can help make some informed decisions on how to invest in real estate. Because as you know, Scott, there's a lot of stuff out there, and it's really difficult to sometimes, swim through it all and figure out what's the best fit for you as an investor. So hopefully we shared a little light on that, and hopefully we can help some people out.
Amen, man. Appreciate you sharing all that, Nick. We'll talk to you real soon, dude.
All right, buddy. Take care. Thanks again.